Hello, this is Joe Pryor with virtualrealestateteam.com in Oklahoma City, part of Redbud Realty and Associates. And this is part 2 of our current series on investing in real estate. Now in part 1, we did a general overview. We kind of talked to you about what percentage maybe of your investment portfolio you need to think about putting into real estate, not putting all your eggs in one basket. We talked about having an experienced realtor. We talked about choosing markets. Now today what we're going to talk about is we are going to talk about in this video a couple of definitions of terms about how we measure whether it's a good investment or not. Now there's a lot of realtors out there, experienced realtors like myself, that can look at a property, do a market analysis for you, and say, well, you know, that's a pretty good deal. In other words, ultimately the value is $200,000, but you're getting it for $175. These comps support $200, so we have a $25,000 equity. Well, that's terrific. That's what we all should know how to do. But when it comes to investment, that is not enough. That is only telling us if it's a good buy and do we have equity, but it does not tell you what constitutes a good investment property. And this is what we're going to go into in these next 2 videos. Now in this first video, I want to talk about 2 definitions which are what we call snapshot definitions. These are important because they're going to give you real numbers of what you can expect in the first year of owning that property. So now if I've done my job properly, if I'm experienced, have a good property manager, I vetted it out, I looked at a rental CMA, we take your property that you bought and we're going to analyze your returns. Now, for the sake of this video, we're going to make it $100,000. That makes it easy to understand. So we have $100,000 gross into the property. So the first thing we're going to do for you is we're going to look at what the capitalization rate is. So we take that $100,000 that you invested, and then what we do is we take what is called your net operating income. Now this is going to consist of what it's going to cost you to maintain the property, what it's going to cost in terms of taxes and insurance, certain things that are going to be very, very important in terms of determining what our return is. All right, so in that particular respect, we're going to say that we have a $10,000 in terms of net operating income. Basically, that means we take our gross rents that we get in 1 year, so if it's $1,000 a year, it's $12,000. And of course, it'd be a little bit more, we hope, than that on a $100,000 purchase. But for the sake of the argument, we're going to say that we have $2,000 in expenses. That's obviously low, but for the sake of this argument, let's say the net operating income is $10,000. So $10,000 is 10% of your gross purchase price. That is what's called a 10% capitalization rate. We can assume that if we keep this rate going, that we have enough net operating income to equal the purchase price in 10 years. So in that particular case, a 10 cap or 10% capitalization rate is kind of a magic number, I think, for a lot of people that invest in real estate that are knowledgeable. All right, now we take a second definition, which is cash on cash. And for this, what we're going to do is we're going to take that net operating income, that $10,000, and then what we're going to do is we're going to take out, in this case, the debt service, which is the principal and interest. So, because we're assuming that we have a loan on this property. So in that respect, we take that and we reduce that, and we find out that after debt service, we have X number of dollars left over. Now, this is a real number. This is going to be your total expense on what you have on the house. And then at that point, I take the amount of money you put into a down payment. So if in case it was $100,000, it'd be $20,000. Say you had $3,000 in closing costs, that's $23,000 of real money. What cash on cash means is after we paid everything, and this is what we have left over, what is the percentage of real cash do we get back on that investment property? So let's say, for instance, that we computed the principal and interest reduction off the net operating income, and you've got 20% of your money back. So of that $23,000, you got $4,600 back in the first year. So that is what's called cash on cash. For the cash out, this is what you got back in that first year. Then we can overgeneralize a bit and say, well, if we keep this up, that in 5 years, we would have all the cash back of our investment in that 5 years. We'd recover our real dollars that we put out, but we're still cash flowing. So these are 2 very, very important definitions that we look at. First is capitalization rate, which tells us on our net operating income, what is the percentage versus the gross price that we paid for the property. Then we take the net operating income, reduce our principal and interest payments, and that constitutes our cash on cash, or how much of real dollars do we get back in the first year. Those are very, very important. They're snapshots. In the next video, what I'm going to do is talk about internal rate of return, a more complex formula, a little bit of supposition, a little bit of guesswork, because what we're going to do is we're going to look at that investment and how do we analyze it over the life of that investment. This is Joe Pryor with the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.